Imagine making consistent monthly income from your stock portfolio, even if the stock market has flatlined or it's just going up a little bit. That's the power of a covered call strategy, but there's a catch. In order to be able to execute a covered call strategy, you need to have a minimum of 100 shares in a single stock, which that will run you thousands up front, and it'll completely lock you out of your stock's upside potential. If you're a late starter or you just don't have a ton of money that you can tie up right now, you might be thinking that this strategy is not for you. But stick around, because I'm going to be sharing with you a major shortcut to bypass all those rules so you can participate with whatever money you have. Today I'm breaking down how covered calls actually work using real numbers. And then I'm going to be sharing with you my major shift that I made in my own portfolio, moving away from traditional covered call funds like QYLD into next generation NEOS ETFs, SPYI, so it can help me build my dividend portfolio. If you're new here, my name is Shell. I am also a late investor who does not have thousands of dollars for covered call option strategies. I am not a financial advisor. This video is for education and entertainment purposes only. So what actually is a covered call ETF? It's an option strategy where you create a contract to sell a stock you already own at a specific agreed price. The specific price is called the strike price. You also set a time limit, usually a month or a couple of months. Once you put that contract out there, a buyer on the other end says, yeah, I want that deal. To lock in their spot, they pay you a certain amount of cash up front. This cash is called a premium, and it's yours to keep no matter what happens next.
Wait, Shell, let me make sure I've got this straight. The premium is basically like a non-refundable deposit? They pay me cash just for the right to buy my shares later?
Exactly, Henry. It's just like a deposit. And as the seller, this can work in your favor in two different ways. Scenario A. If the stock price stays low and never reaches your strike price before the expiration date, the contract expires worthless. The buyer gets nothing, but you get to keep your shares and you keep that premium cash. Scenario B. If the stock price hits or passes your strike price, the buyer will likely execute the contract. You get paid the full price for your shares, plus you keep the premium. It's like a total win-win. Okay, let's look at a scenario that uses real numbers. Let's say that you own Apple and you have 100 shares in Apple. And right now, the share price is $200 per share. So you go ahead and you decide to sell a call option with a strike price of $205. And you're looking at expiring 1 month out. The buyer pays you a premium, let's say about $500, and that holds that person's spot.
Math time! 100 shares of Apple stock at $200 means that you had to spend $20,000 just to play this game. That's a lot of sunflower seeds, Shell.
It really is, Henry. And that's a big barrier for many late investors or people that just are starting out and they don't have that much money. But let's see how this ends after 1 month. Outcome 1, the stock stays flat. Apple stays under $205. The contract expires worthless. You keep your $20,000 worth of Apple stock, and you pocket the $500 premium. That's pure extra income. Outcome number 2, the stock shoots up. Apple climbs to $210. Because it went past your $205 strike price, the buyer forces you to sell your shares at $205. I mean, they're getting a discount, right? You get $20,500 for your shares, plus you keep the $500 premium. You made a great profit, but yes, you did miss out on the extra climb to $210. And that's just something that you have to be okay with. So you can see the biggest risk here for covered call options is that your shares can be called away, which just means that you have to sell your shares if the buyer wants them. And then while the contract is active, you can't do anything with those shares. You can't buy more shares. You can't sell your shares. They are tied up. Now, if you're someone like me who likes the idea of the stream of income, but you don't have the money for it, you don't have hundreds of shares in a stock, you don't have $20,000 lying around, and you don't have the time to manage or monitor the options every week. Well, there is something else you can use, and it's called a covered call ETF. But now here's where my personal journey did take a turn. I did have traditional covered call ETFs like QYLD because that's what was around, but they have a major flaw. They sell at the money, which means they will cap any upside in order to give you that high dividend. So what I did was I actually changed from a traditional covered call ETF like QYLD into a NEOS ETF SPYI. NEOS does 3 things differently than traditional covered call ETFs. Number 1, they capture growth. Instead of capping the upside, they write out of the money calls. This means if the market is going up, they are able to actually participate in that potential growth while still paying out those massive monthly payouts in dividends. Number 2, tax efficiency. This is a big one for many people. Traditional covered call ETFs distribute income that is taxed at your ordinary income rate, whereas the NEOS ETFs, they have what's called 1256 contracts, index options, which automatically qualifies you for 60% long-term and 40% short-term capital gains tax split. That just means you get to keep much more of your dividend payout. Now, unless you are doing what I'm doing, which is a Roth IRA, then it's pre-tax, so all the dividends you get, it's all being reinvested. You don't pay any taxes on it. If that sounds like something you want to learn more about, definitely check out the video that I'll have at the end of this video, where I share with you the differences between SPY and SPYI and how it helps you better with your long-term dividend investing. Number 3, active management. This just means that the managers that are in the NEOS ETFs are actively buying protective options to help mitigate any downside risk when the market doesn't do so well. If you want to know more about NEOS ETFs and why it's great for late investors, definitely check out the video at the end of this video where I actually discuss the differences and how it's better for late investors to go with SPYI versus SPY. So definitely check that out. Now my NEOS ETF SPYI has allowed me to enjoy a covered call strategy where I do not need thousands of dollars to participate, and I don't have to be actively participating in it and just making sure the strike price is good, the premium's good. I don't have to do any of that because I'm investing in the covered call ETF. Now, I highly recommend going with the NEOS ETF, but if you put it into your Roth IRA, you're fine. Either way. I hope you found this video helpful. Thank you so much for watching till the end. Don't forget to check out the next video here to learn more about the benefits of owning SPYI as a late investor. Until next time, bye.